Obviously, it started with a conversation about Iran and the headlines out of that region, and the market's response as well. Markets seem to kind of have a couple of days this past week where things were a little bit more stable, but prior to that, it had gotten into sort of that correction territory kind of range. And all that means, just so you can appreciate what that term actually describes, is that means that the markets have had a decline of 10% or more from a previous high. So that's the technical definition of a correction, a decline of 10% or more, which, by the way, occurs on average about every single year, just for perspective purposes. But we thought it would certainly made for those headlines, obviously made for a much fuller conversation at our educational event this past week. And Chief, as we said, is the conversation about Iran. Obviously, nobody likes military conflicts. Nobody likes loss of life when it comes to a military conflict either. But on a historical basis, these types of geopolitical events, they certainly have sharp emotional impact, but they have relatively short market impact. And if we go back through history and over the past many decades, and we see these conflicts, the reality is that the market has a tendency to recover relatively quickly. Key takeaway, obviously, is that global tension's not really a new concept, and the markets find themselves navigating, and certainly have a history of navigating, far worse environments than kind of the current situation.